we've got quite a bit more pain to go here, is what you're saying.
Yeah. Just based on what's going on in the world, I think it'll be another. I've heard anywhere between like 6 to 24 months. That's kind of the estimate of how long this is going to continue for.
Jeff Mudrick, thanks so much for coming back on again. I really wanted to chat with you because, frankly speaking, people are really scared right now, and I don't blame them. So I wanted to get your take on what's going on with the banking system, with mortgages, fixed rates are going up. Kind of give us a breakdown of what's going on.
Yeah, so everything you said is 100% accurate. So we saw after about 3 months of the fixed rate steadily decreasing quite a bit. They were at like from 5.5. You could have got them as low as 5.3. So they came down quite a bit. We saw that all go away this week when every bank, every lender has increased their 1, 2, 3, 4, and 5-year fixed rates. They all went up by about 0.25% on average. So whether you're looking at an insured mortgage, which is less than 20% down, or an uninsured mortgage, which you have more than 20% down, fixed rates have gone up around the board.
Why is that happening?
So we saw the bond yields become a bit more expensive, and that is kind of the main reason why fixed rates rise and drop. And the other thing to note is right now, variable rates are still a little bit on paper, quote unquote, cheaper than fixed rates. However, in just under 2 weeks, on October 26th, we are very much likely to see another variable rate increase by who knows how much this time, but it's gonna pop up again, and which will, for the first time in many years, make variable rates more expensive than fixed rates.
Okay, so that's a big statement. Now, what are you anticipating? I mean, I'm not going to hold you to it. I know it's just your opinion, but what are you anticipating that we're going to be seeing on October 26th from the Bank of Canada?
Yeah, I'll make a prediction. Why not? So I'm going to say we're going to see a 0.75% increase. Either I'll say one or two things. We're going to see a 0.75% increase, and that's the last one of the year. Or we're going to see 0.5% increase on October 26th, and then maybe another little one in early December. So I think there's going to be, in one way or another, there's going to be either a big increase now, or there's going to be 2 increases before the end of the year.
Wow, it's like that, huh? I mean, that's really
Yeah.
aggressive.
Not what I want to happen, but I think one thing I've learned over the past 9 months is let's plan for kind of worst case scenario and work backwards from there. Like, however, I'm qualifying clients based on a 0.75% to a 1% rate hike in a couple weeks. That's why I'm pre-qualifying everyone moving forward.
How much does this have to do with the global macroeconomic situation, especially having to do with the Bank of England and the measures that they're taking now to try and stabilize things over there? Is that affecting us?
Yeah, like we're seeing this. It's just something for people to note is that it's not just Canada, not just Ontario, obviously, not just Canada. We're seeing this all over the globe. I know, Adam. I know I think you posted some numbers recently as well, just showing that it's in England, inflation is at an all-time high. What they've done to their interest rates and what is essentially their economy is taking a huge hit. We saw the Federal Reserve, they're going to continue to increase rates, and all this has a huge impact on the Canadian market and the Canadian banking system as well. So yeah, it's I don't know if this is helpful for people to hear, but it's not only the Canadian interest rates that are rising, it's essentially around the globe.
What are you advising your clients to be doing in this climate?
Clients who currently own a home, I've had a lot of conversations, especially in the past couple of weeks, of hey, should I be? Most of my clients over the past few years have had a variable rate, and they've reaped the benefits of that. And now it's come time for them to say, what do we do? My calendar is essentially booked with past clients saying, hey, what does locking in a fixed rate look like? we understand all the benefits of a variable rate, one of which is to switch to a fixed rate whenever you want, free of charge, which is great. And now clients are looking at that as a potential real solution. So my advice to clients, I ask clients the same questions. It's one, how are you feeling? Like, are you losing sleep every night when you hear the interest rate increases or interest rate talk on the news? If you're losing sleep, then hey, let's look at locking in a fixed rate. The goal is to make sure you are comfortable with that monthly payment. And if you're not comfortable with that, then maybe it does make sense to switch to the fixed rate and you are consistent for the next however many years. The one recommendation I'm giving clients is, hey, let's not compare your current 5-year variable with a 5-year fixed, because 5-year fixed, interest rates haven't been this high since 2008. So why would we lock in the highest interest rate we've had in 14 years for 5 more years? So what it depends which lender clients are with, but I've had clients with certain lenders be able to lock in a 2 or 3-year fixed, which might be a decent idea. And then kind of kicking the rate conversation down the road a few years. So these are the types of conversations we're having almost daily.
And so it's based on their threshold of their stress tolerance for
100%.
to be able to stomach what's to come. Now, having said all that, the one thing that I've been growing a little bit concerned about are the people, and I mean, you'd probably have a better idea about
I
this
know
than
what
me.
you're going to say right now.
The people who bought in 2018, they're coming up on their 5-year term, and they're going to hit renewals where rates are going to be astronomically higher than what they originally had locked in for, and sometimes double. Now, what does that look like from your end?
Yeah, so there's two things. One, it's, hey, a couple things to note. One, back in 2018, interest rates were not what they were in 2020 or 2021. So most clients in 2018, they probably locked in somewhere between like a 3 and 3.5% interest rate. So we're not going from like 1.5 to 5.5. We're going from like a 3.5 to 5 or 5.5, maybe a little bit more, which is still a very, very big jump. So first thing we have to note is, yes, monthly payments are going to increase, but before that, it's, hey, what life changes have happened over the past 5 years? Have there been an increase or decrease in jobs? Have there been kids added to the equation? Because the first, more important thing we have to worry about is, hey, can these clients still qualify for a mortgage? What they were used to qualify with 5 years ago is out the window. That 5.25% stress test no longer exists. What everyone has to qualify on now is their interest rate plus 2%. So if interest rates are at, let's say 5.5%, then we have to qualify everyone as if interest rates were 7.5%, which on average has decreased affordability for the average buyer by around like 22 to 25% in 2022.
So what happens then? What happens if I am somebody who owns a house, I bought it in 2018, and my 5-year term comes up in, let's say, February, and now I need to qualify at a 7.5% stress test rate, and I don't qualify? What happens? I mean, I know I've had 5 years to pay down my mortgage and things like that in that case, so I'm not as bad as someone who just bought last year, but
yeah,
still, let's say I don't qualify. What happens then?
yeah, great question. So taking aside everything that you mentioned, like, let's say their income has not increased, let's say there hasn't been any life changes, and they literally just don't qualify for a mortgage. There's kind of two options. One, again, depending on which lender that they're with, it might be as simple as signing a piece of paper, taking whatever that current lender's rate is, signing it, and moving on. Some lenders do that where they don't do any underwriting. They just send you the renewal notice. Other lenders will do a bit more underwriting and make sure that you can still qualify. So let's talk about clients who do not get that automatic renewal. This is a real thing, and I've had clients in the past week who have said the same thing. Hey, can we still qualify? And the answer is like, technically, no. So what clients have to do is, unfortunately, we have to go to like the alternative lending space, which it's just an alternative. It's not, it's going to be a bit of a higher rate for the next, sign them for a 1 year term. Hopefully rates drop after that. And then they're in a bit of a better position, but it's more expensive. There are fees associated with it. And obviously, we got to be able to stomach those increase in monthly payments.
Oh my gosh. Okay. I have a lot of questions from there. Because that kind of opens up a can of worms, just so that we can give some insight for viewers who are watching this. In your experience, which of the A lenders will just send that renewal and not do any underwriting? Which of those lenders of A lenders will do underwriting?
It depends who. So every lender that I work with, they will essentially send a letter that says, "Hey, here's your renewal." There are some discount lenders out there who offer you fantastic rates, or these kind of like, I don't want to call them like fake rates, but these rates that have like contingencies attached to them. So hey, you might save an extra $3 a day on your mortgage, but here are like these weird clauses in there. So any like of those types of lenders, that if you Google cheapest interest rate, most of those lenders that pop up, those will be the ones that will probably not send you the automatic renewal. Most big banks, or every big bank will. Any like larger monoline lender like the First National, MCAP, RMG, Strive, these ones will also send you. I would say it's very likely that they send you these automatic renewals, and then there will be others who do not.
So the big five will just renew it.
Yeah, again, basing it off of what I've seen over the past long while, yes, they will. They want the business, but maybe they're not sending you a 5 year term to renew. Maybe they're asking you, hey, do you want to lock in a 1 or 2 year term instead?
Okay, and when it comes to the others who would be giving these attractive rates, the Meridians, the Equitables, Duca.
Yeah, I've seen some very messy situations with. I don't want to speak badly about any lender, because sometimes it's in the best interest of the client to go with one of these other lenders. But yes, I've seen some situations where, hey, after 1 year, I'm working with a client now whose mortgage comes up for renewal in February, and unfortunately, they will not qualify with the same lender that they were with, and we need to find them another solution. And this is one of those discount lenders.
Okay, so now when you're having to find somebody a different lender, what kind of rates are we talking about now? Because I know that because now everything has become so tight in the financial institution world, that B lenders are having a field day with this. So
Oh
what are
yeah.
those guys charging right now?
So the good news, I guess, is that B lender rates typically will rise and fall about 4 weeks after the A lenders do. So right now on the A side, standard 5 year fixed rate is around 5.5%. On the B side, a standard 1 or 2 or 3 year term fixed rate is around like 6.2 to 6.5%. So it's not a dramatic increase. However, when we talk about alternative lending or B lending, there are other fees associated with getting that mortgage. So most common one is like a 1% fee, 1% of the mortgage size, and that money is just due upon closing. So that's coming out of clients coming out of their pockets.
Or is it coming out of the equity of the property if they're renewing?
Just coming out like if they're just renewing their property, it's just an extra however many thousands of bucks out of their pocket. Yeah, it does not come out of the equity.
So that can be pretty hefty then.
For sure.
Okay, so now because of that lag time, I guess in the B world, or for those who will be going into 2023, we're talking about prime possibly hitting 6.2, right? Something
Yeah,
like that,
I think that's
right?
pretty fair.
By
Sure.
the end of this month. Within the next week and a half of today, we're shooting this on Friday, October 14th. So we could see prime at 6.2,
Yeah.
and we could possibly see after that B lenders fixed rates going up to the 7.3,
Yeah,
7.4
and
range.
some already are. Some are up there just because, I won't bore everyone with the details on how to qualify. But some lenders, how we talked about earlier, the stress test, you take your interest rate, you add 2% onto that, and that's how you get qualified. Some alternative lenders will say, hey, you just qualify your contract rate. So instead of qualifying at 7.5, or your interest rate plus 2, you can just qualify on your interest rate. So those lenders are great options. However, they know they're a great option, so they charge you a bit of an interest rate premium because of that.
So now we've got quite a bit more pain to go here, is what you're saying.
Yeah. Just based on what's going on in the world, I think it'll be another. When clients always ask me for the crystal ball, it's an impossible answer to give. I got to order one and just show them that I do have one. It's just not working right now. But I think it's probably going to be. I've heard people say it's going to be another 18 months of not necessarily increases, but no decreases, and just like a steady hanging around 5 to 6%. I've heard anywhere between like 6 to 24 months. That's kind of the you know that's the estimate of how long this is going to continue for.
Okay. Well, that definitely gives some insight into what's going on right now. And I'm sure it is definitely not an easy time for you, to kind of being the bearer of bad news a lot of the time for people. And a lot of people, I think, often think to themselves that um, everything that the future anticipation of what's going on and what's going to happen is priced in. Frankly, on my side of things, that's not what I'm seeing. I'm not seeing the future being priced into the real estate market right now. I think pricing is lagging behind.
Yeah, I'm going to jump in there and just say, so the fixed rates, they have increased by that 0.25% or even a little bit more this week. So on Monday and Tuesday of the week of October 10th or whatever it is, I'm sorry, Tuesday or Wednesday. So what happens is, if you're working with a mortgage, if you're out there working with a mortgage broker or just curious around rates, this is why it's so important to have somebody in your phone you can call or text, or really they should be contacting you, because when we get the mortgage brokers, we get notice at least same day or hopefully next day notice of when rates are going to rise or fall. So we got the notice on Tuesday that fixed rates are going up by 0.25% pretty much across the board. So any one of my clients who have not already purchased a home got an email from me explaining exactly that and saying, hey, if we want to lock in, we can do that. We need this information from you. It's not a whole gamut of, hey, we need an employment letter, pay stub, we need all that. It's all my clients were already essentially pre-approved already, but then we locked it in. So now clients have 120 days to go shop around and buy a property, knowing that they're going to have an interest rate at least a 0.25% lower than what today's current market is.
Okay. So yeah, people got to be on the ball, basically, is the message. You've got to stay on top of it. You've got to be speaking to the professionals around you and get ahead of things right now, because it's going to be.
It's going to get ahead of us pretty soon. Yeah.
All right. Well, Jeff, thank you so much for taking the time and speaking with me again. We're definitely gonna keep tabs on this with you.
Looking forward to it. Sounds good. Thanks for having me.
Thanks, man.